Hey traders, Stephen Kowitzel here. I want to wish everybody a happy new year. 2019. I am recording this early Tuesday morning on January 1st. I'm up early because I don't go out anymore. I spent my evening watching Hotel Transylvania with the kids. So, kind of back to work for me. I've been working on some 2019 trading goals as well as personal goals, as I hope you have, written them down. I have a little book that I just, write my goals and what I want to work through, especially from a trading standpoint. So I want to talk to you about some of that stuff today. I really want to talk about, risk management, and we're going to look at a lot of things. One, we're going to look at the trader's plan performance in 2018, every trade. So I'm just going to show you every trade that was made, or at least the performance of the cumulative trades. That way you can look at it and see for yourself. And I always believe in transparency. So I'm going to show you that, and we're going to look at that. And I was actually pretty pleased with the results for the year. We're going to look at some risk management strategies, which really centers around what I'm trying to do in 2019 as far as psychology. I've been reading a lot of trading psychology books, and I'm convinced that 90% of the mistakes are psychological. So I've been really working on some things to put in place to make sure that I can be at my peak performance for you as a subscriber, and especially to the paying subscribers and my trading system subscribers as well. So we're going to look at that. So I have a lot of individual rules I'm going to cover today, whether for risk management and position sizing strategies. And then, so we're going to do the order a little different. First, we're going to look at the performance of the trader's plan. Then we're going to look at some risk management strategies. Then we're going to cover the individual markets. So let's dive right in. So, I really have two main services. I have the swing trades and the weekly reversals, and this is just part of my monthly or annual subscription. They come together, okay? So, but I separate them out because they're two different really patterns. I have my swing trades, which is my growth stocks, and I have my weekly reversal patterns, which is my bottom picking pattern. So let's start up here at the top. Now this is every trade that was started in 2018. If it started in late 2019 and then closed in started in late 2017 and then closed in 2018, it doesn't count. Just the ones that were started in 2018. Took 34 swing trades for the year. Total wins of 22, total losses of 11, 67% win ratio. That's actually pretty good. The average wins, 5.17%. The average loss is 5.39. So I definitely need to work to improve that. That needs to be a better win to loss ratio, but because the win percent was actually still so good at almost 70%, we still had a good net trade of 1.6%. Now, what does the average trade of 1.6% mean? That means that once you take out all the wins, once you add up all the wins and then take out all the losses, every single time you hit that buy button, you're going to make 1.6% on a trade. So, might not sound like a lot, but it actually is when you net them all out and then you add them up, over 34 trades, 1.6% per trade. I'm sure you can do the math on that. You would have done pretty well if you would have taken every trade. Again, this is assuming you're taking every trade. So, not bad, not bad. I'm going to work on this right here, and I'm going to show you how I'm going to work on it here in just a little bit. The weekly reversal patterns. I really didn't do a lot of trades in December for obvious reasons. I'm the kind of person that I don't like to swim upstream. The market was bad. We're in a bear market, so I traded less. The weekly reversal patterns, a lot of them were front-loaded in the first 6 months of the year, the first 9 months of the year. 46 trades of the weekly reversal patterns, 28 wins, 18 losses, so 61%. And, this was 70%, but I think the month of November we had several that we got stopped out, and it just lowered my ratio. And hey, that's a part of trading. One thing I noticed looking back on all my trades, I go on massive win streaks and then I'll lose a few in a row. So, the average win is 10% because that's our price target for the weekly reversals, and the average loss is 8.4. So here's what's interesting. Even though the win ratio is 61%, less than 67%, our actually average trade is 1.86%. So that means out of 46 trades, if you'd have taken every one, you would have made 1.86% on every single trade of the 46 trades. So it's just interesting, and this is just kind of goes to show you sometimes that you don't always want to be closed-minded and just focus on win percentages. I know that's what a lot of people focus on to get you sucked in, but really what you want to focus on is the average trade, right? Because if you have a high, you can have a 90% win ratio, but if your average trade is only 0.5% or 0.25%, that sucks. That's not what you want to do. You know, your commissions, ticket charges for placing the trade are going to eat you up. So I would say the weekly reversals, even though they didn't have as good as win ratio, they actually did better as far as the average trade per year, and the average win was greater than the average loss. So again, those numbers are pretty good. Now, the QQQ trading system, now this is totally different. This is nothing like the two. This is my trading system. This is, you know, where you are invested, really only in the best, you know, 40% of the time when we're in an uptrend. Normally it's about 4 to 5 trades a year. We had more trades this year. We had 7 trades. We had 4 wins and 3 losses, so 57%. Average win of 3.6%, average loss of 1.2%. That's a 3-to-1 ratio. That is perfect. That's what you want to see. A 1.57% per trade, and the 2018 annual return of the QQQ system is 11.3%. Now, 11.3% might get you excited, might not, but when you think about the negative 6% of the S&P 500, and then you think the fact that when you add those two, this outperformed the market by 17.3%. So it outperformed the market by 17% for the year. Will you take a 17% rate of outperformance of the S&P 500 every year? I bet you would, and I most certainly would. So I'm incredibly pleased and proud of that we had a 3-to-1 win ratio, and that we beat the market by 17%. Now, with the TQQQ, this is optional, right? This is for people that want a little bit more juice. You obviously have more risk because you're using leverage, but, you know, you just take the same trades, you just buy the leverage version instead of the non-leverage version. So all these numbers are obviously the same. The average win is 10.15%. And the reason why it's not exactly 3% or 3 times this is because it doesn't always track exactly 3x the QQQ. So the average loss is 4%. So you have about a 2.5-to-1 ratio. That's still very good. Average trade is 4.14%. That means if you would have taken all 7 trades, you would have made 4.14% on every trade. The year-to-date rate of return, or excuse me, the 2018 rate of return for the leveraged version is 30.38%. And if you add the negative 6% in the S&P 500 that it did for the year, you were to beat the S&P 500 by 36.38%. Not bad, right? I mean, who wouldn't take a outperformance of something like this? So, I mean, if you look at it across the board, if you are more of a swing trade person and you like the action, and you like the retirement income, I think these would be a good plan for you. So you can just go to Traders Plan right here and go to thetradersplan.com/subscribe, and you can go to the monthly plan at $47 a month, or you can go to the annual plan, $267 a year. So if you go to the annual plan, you get 50% off, plus you get text alerts. And you get a couple extra courses if you want to go with that plan. So not bad. If you like that kind of action, that's for you. That's good retirement income right here. This is a good retirement income builder right here. So whether you're accumulating assets for retirement, trying to retire early, or are looking for a nice yield at the end of the year to pull off your account, I think this is pretty good right here. So you can just go to the tradersplan.com checkout -TS. Now you want to use the code 6FREE. So this is for a 12-month subscription, but if you add the coupon code 6FREE, it will add, and on the second page of the order form, it will add an additional 6 months and making it an 18-month subscription. So again, let me know if you have any questions about these. I had a subscriber that wanted to know my results, so I tallied them up, and I was actually very, very pleased. But again, it all boils down to sometimes if you pick and choose the trades that you want, if you're a paying subscriber and you pick and choose the trades that you want to make, sometimes you're going to pick wrongly, right? So I think it's important that, if you like my style, to take them all. If you're a paying subscriber, take them all, and at the end of the year, even though November and December suck, at the end of the year, you would have made out very, very nicely, and especially, I know the people that are in the QQQ system are very happy based on the performance. So, there it is for all eyes to see. Those are my numbers. I'm very pleased with them, and, if you want to come join us, go ahead and go to the subscribe, or if you want the trading system, go to checkout-TS and use the coupon code 6FREE. Let me know if you have any questions. Now, to the risk management side of things, let me take a sip of coffee. I want to talk about risk management because a lot of my mistakes, I believe, for the year, and I'm always working on mistakes, and I'm always sharing my mistakes because I think that's incredibly important. We're in this together, and yes, I'm the supposed guru, but I'm also very human. I make mistakes all the time. I try to log them and put rules in place to avoid them going forward, and I really hope you do the same. And if you don't, maybe you can make that a goal for 2019. To really try to put some written set of rules in place, a trading plan, to keep you out of trouble. Believe me, I had plenty of emails talking about, people losing money, not from my trades, from their portfolios, and, they needed a plan. So, I try to talk them through it. So I want to talk about, risk management, and the theme is going to be position sizing, right? And I've been reading a lot of Dr. Van Tharp's books, read like 3 of them, and it's just kind of making a lot of sense. And now every book you read, you're going to hear about the risk 2%, of your portfolio on each trade. So that's kind of the common, rules for trading. Don't risk more than 2% of your portfolio. So I'm going to walk through some of the rules and some of the cons and the benefits and the downsides of risking 2% on each trade. And then I'm going to walk through the risking 1% of the portfolio. So if you risk 2% of your account balance on your portfolio, I'm not saying that if you have a $100,000 account, you're only putting $2,000 in a trade. I'm saying if you have a $100,000 account and you buy a $25,000 stock, you're only risking $2,000 on that $25,000 trade. So once, your $25,000 goes down to $23,000 on that trade, boom, you're stopped out. So an easy way to figure out the risk 2% is you multiply the number of positions you want, whatever you're comfortable with, by 2%, and that equals your stop loss. So for example, and this is normally what I've done, so I'm just going to kind of bold this. This is what I've done in the past, and I think I'm going to change this a little bit to see if I can improve, if I can limit my mistakes. I'm not going to say improve my numbers, because I think if I limit my mistakes, I'm going to improve my numbers, but so 4 positions at 2%, that's about an 8% stop loss, okay? So if I want to have 4 equal size positions and I want a max percent of 2% on each position, so that's 8%. So that means if, I can lose I can lose on 4 consecutive trades, right? And my account balance is going to be down 8%. Maybe you want more positions. Maybe you want 7 positions in your portfolio. That makes you a little bit more comfortable. And you use the 2% rule. That means you can have a 14 every trade. You have an equal weighting of 7%, or 7 positions in your portfolio. So whatever 7 divided by 100 is, probably, 15, 16, something like that. 1,000, that's how much you want to put per trade, with a 14% stop loss, okay? And that will mean that if you lose 14% and you have 7 equal positions, your account balance, your $100,000 account balance, will only be down to $98,000. And this is what we're going to use that $100,000 because it's a round number. So this is common, right? So I want to talk about some benefits and some downsides using the 2% rule. Some of the benefits. You make each position size the same. I think you have to do that. It's when you're using the 2% rule. It's very, very simple. It's easy to understand and easy to follow. You just make each position size the same, and then you put your 8% stop loss in. And sometimes I don't always let it get down to 8%. My average loss, as you can see on the swing trades, if we go back here, it's more like 5% on this one. But you know, we won't get too deep into that. So the benefits is you can make each position size the same. It's very simple. Larger potential upside, which you do because you're risking more per trade. So if you go on a nice win streak, you're going to have a larger upside. Simple way to calculate, which we kind of, you know, attach that. So however many positions divided by the time multiplied by the 2%, that's your stop loss. Very easy to calculate. Avoid bad trades. Now, I put this as a benefit because you have to make each position size exactly the same. And this is something I did a couple years ago, and it improved my trading because what I was finding is some trades I'd, you know, buy $10,000 worth, some trades I'd buy $5,000 worth. And it was all depending on my feelings, right? Well, what I find that the $5,000 trades were the winners and the $10,000 trades were the losers. So I made a rule, every position size needs to be the same. And if I'm not comfortable making a trade the full size, then I shouldn't be taking it, right? I'm probably gambling, or there's just something wrong with the setup that is causing me to feel uncomfortable taking a full position. So I just avoid it. Avoid the bad trades. Reach financial objectives quicker, right? Again, more upside. The more you risk of your portfolio, the quicker you're going to reach your financial objectives. There's a downside to that too. Now, again, I don't think you should go to 3, 4, 5%, because if you go on a bad losing streak or make some bad mistakes, you're going to get wiped out very quickly. Now, the downside to that is you're going to have greater volatility, okay? Because your positions are bigger, right? So if you have a bad day or a bad November, December in the market, and hopefully use a stop loss, so you know your losses were capped, but you're going to have greater volatility and you're going to have greater drawdowns, because if you're using this rule right here, 5 losses in a row and your account is down 10%. Now, I'll typically have a rule. If I take 3 losses in a row on swing tradings or weekly reversals, my positions are getting cut in half. They're going to go from 4 equal positions, and I'm going to cut that quarter position in half to an 1/8 position, right? Because that just means that I'm either off on my trading or something else. So you can always have a rule: when you lose 3 in a row, you cut the next one in half until you get 2 in a row back, and then you can go back to your normal position sizing strategies. Tend to take profits quicker. So I put this as a downside. When I make emotional mistakes. Again, because you have bigger positions, I do believe, and this is maybe this is just me, but when I have bigger positions, I tend to make emotional mistakes. And one of my emotional mistakes is I take quicker profits than I know I should be doing, right? Because I have a larger position. I don't want to let a large win when I'm looking at my equity curve come back down to a loss. So I'm making emotional mistakes because I have a larger position, and a lot of times my emotional mistakes, I take profits too early. Tend to pass on good trades after a losing streak. Again, I'm speaking about myself here. I do this, I tend to clam up sometimes, and this is something that I continue to try to work on, and I get that I'm totally ragging on myself here. But imagine if I could fix these 2 problems and make these numbers even better, right? So I have a lot of problems, and I still had great numbers last year, and I still have problems I need to work through. So one of the best, tend to pass on good trades after losing streaks. This is why I focus on psychology, position sizing. This is just some changes I personally am making, and I hope that I inspire you to, have some ideas as well. So, one of the best things I ever heard was in one of the Market Wizard books was, I think it was Ed Seykota, I don't remember, but he said, or one of the traders said, you don't want to, have an empty rifle when the white elephant walks by you. And what he means by saying that is, you don't want to have messed with your psychology so much that you miss on a great opportunity, because you're emotionally, kicked in the teeth, whatever you want to say about that. So, so I do think that the more you risk on your portfolio, the quicker you're going to take profits. And you should test this yourself and think about it. Ask yourself, if you have a larger position, do you take profits quicker? Do you tend to change your trading style after you go on a losing streak? I think cutting your position sizing in half is a great strategy after you go on a three loss lose streak. I don't think that's making a mistake. I think that's good management, but totally passing on what you know is a good setup, what you know is a normal setup, because you just took a bunch of losses. That's what we want to avoid. So there are some really good things and some really bad things, I think, and I'm just trying to lay it all out here so you can decide what's best for you and give you ideas. So here are some potential rules for using the 2% for your portfolio. So stop at 8% per this risk, and if you have 7 positions, stop at 14%. So your profit target, number one, I believe should be 8 to 10%, right? You sell half at 8 to 10% because you have a larger position. So you need to take some of that off the table. Raise stop to break even on your remaining shares, and then let the rest ride. So it's very simple. If you have a quarter position, you have a stop at 8%. You sell half at 8%, raise your stop to break even. That way, if it rolls back over and hits the break even, you just netted 4% because half is 8, half is 0, net 4. And then you let the rest ride. Letting the rest ride could be different to everybody, but just use a 50-day moving average. Who cares? It's so simple. It's a trailing stop. However you want to do that. But if you have a trending stock, it's going to trend above the 50-day moving average for a while. So you can let the rest run. So if you hit an 8% price target on half, you're either going to hit a 4% gain because the rest is going to stop you at 0, or it's going to run and you're going to make a lot more. Okay? Now, I'm going to make the case for only risking 1% of your portfolio per trade. Just 1%. This is a practice that I believe I'm going to start at the new year and see how it goes. Because I want to, sometimes I think I have a problem selling big positions too early. Tend to pass on good trades after a losing streak, and I want to let them ride. So I'm going to show you how I think I can do this by risking 1% of my portfolio. So here's how you calculate that. You multiply the 1% of your account value by the amount risked equals the shares you buy. So for example, if I have a $100,000 account value and I want to risk $1,000 on that trade, that just means that doesn't mean I'm only going to put $1,000 in the stock. That means that if I buy $20,000 worth of Apple, that when it gets down to 19,000, I'm out, right? So let's say, for example, Apple is at 203, and I feel that I picked the spot it shouldn't go below at 198. So that is $5 per share. Well, that's very simple. You take the $1,000, that's the amount you're going to risk. Okay, that's your 1% divided by the $5, 203 by 98 equals, then that tells you how many shares you need to buy, right? Very simple. The amount you risk, the 1%, divided by the dollar per share that you're risking equals that's the amount you're going to buy. And there you got your 1% risk. So what you have to do with this 1% is the minute you buy, you have to turn around and put your 1% stop loss in, right? So that would be a $5 stop loss, right? You buy 200 shares and then you put a stop loss in at 198. Boom. That's taken care of. Now, here's some benefits, and I'm going to highlight these, to risking only 1% instead of 2%. Benefits 1 is you have lower risk per trade. Okay, that makes sense, which is going to equal lower drawdowns. So you can really lose 10 in a row, which I hope that never happens, but you can lose 10 in a row and your whole account is only going to be down 10%. Psychologically, you might be broken, but you can live to invest another day. This is a big one for me. Less emotional attachment. When you know that you're only risking 1% per trade, you are going to be less emotionally attached to the position, which means you can basically buy it, place a stop, and forget about it. You can just completely forget about it because you have your triggers in place, and whatever happens, happens. You don't have to watch the stock because it's not a huge position. So you are less emotionally attached because it's a smaller position and you're risking less. But by being less emotionally attached, it also allows you to take the trades you know you should be taking. Remember, I talked about the white elephant and an unloaded gun. You want that gun loaded every time. So if you lose 3 in a row, your account balance is only down 3%. Who the heck cares about a 3% drawdown? You can take the next trade, and if it's a big one, you can easily pay for those. So by risking less, you're less emotionally attached, and you can take the trades you know you should be taking. Less volatility. I think that's obvious. Allows you to let your winners run. Excuse me, I'm still early. But if you're less emotionally attached, the odds are that you're not going to take your profits early. The odds are that you are going to feel okay with letting it run for a little bit to see if you can have a big winner. Okay? So this, I think, is the key of risking 1%. You're less emotionally attached. You're taking the trade now because you're less emotionally attached. You're taking the trades that you know you're supposed to be taking, and you can let it run more than on a bigger position where you don't want to see those losses fall. The downside. Takes longer to reach your financial objectives, and I have here, or does it? Because I could argue that because you're less emotionally attached and you're going to let your winners run, that you actually are better off than risking 2%. That's just what I'm going to argue. But again, it depends on your emotional state. Make the downside, make more trades. Because you're taking a smaller position, you are going to make more trades. Now, that shouldn't be too big of a deal. Your commissions could be less. But again, you know, these are what I'm looking at right here. Less emotional attachment, never passing on a trade you know you should be taking, and allowing you to let your winners run. And the downside takes longer to meet your objectives. I'm going to argue that it doesn't. I'm going to argue that I'm going to argue that Stephen Kowitzel, does better because I'm going to let my winners run because I'm less emotionally attached. We'll find out. 2019 is a new year. So we already went through this. Now, there is some difference in my opinion. Now, these are just rules. You can adjust and tweak your own, but I do have some rules. With a 1%, since you're only risking 1%, I believe you have to look for trades that you believe you have a 3-to-1 ratio. You know, so that means if you're risking 5%, if you cannot see the potential of making 15% on the trade, you need to pass. Okay? So again, you have to take trades that have bigger potential, because you are taking smaller positions. So the easy thing about this is you place your order, you place your stop at 198, and then you let it ride. What does ride mean to you? You can wait till it hits the 3x target. So that means if you're risking $5 per trade, once you make $15 per trade on the stop, you can exit. Boom, you're good. Or you can just let it ride until it hits the stop, the 198, or breaks the 50-day moving average, whichever comes first. I personally am going to try to do this more. That's me. I'm going to try to do that more. And, you know, we're not in a great market, so maybe at first it doesn't work. But let's say in February and March and the market just absolutely takes off. And then growth stocks start to double, because that's what they do. You know, they go on, great trends come out of nasty markets, and I'm going to prove that to you here in a second. Great trends come out of nasty markets, and growth stocks double. It's a fact. Doesn't mean every time, so don't go quoting me on that one, but, so I hope this was helpful, and I realize that whatever is right for you, I hope that you're just making adjustments to however you handle positions, but If you know you are taking profits too early, it's probably because you have too large of a position. Or if you tend to clam up after a losing streak, it's probably because you have too large a position. Go with the risk of the 1% per your portfolio, risk 1% per trade. But let them ride for a while. So again, less emotional attachment. I'm trying to bold this. I'm just giving you something different to try. And this is kind of eye-opening to me. This is what I'm going to try. And we're just going to see how it goes. I hope that was helpful. Now let's get into the market. Okay, I do want to start with the NASDAQ. And this is, I showed you this chart before, but just talked about how great trends come out of nasty markets. You know, this zigzag line, every time the line makes a zag or a zig, it means that the NASDAQ moved a minimum of 20%. Okay? So after, at the bottom, after the NASDAQ bottomed in March, I believe it was March 9, 2009, the NASDAQ went up 126% before it hit another bear market. Okay? Before it hit another 20% decline. Then, after the 2011 NASDAQ bear market, the NASDAQ went up 253%. Now, I realize this is a straight line. We both know it wasn't a straight line, but it went up 253% before another bear market. So, I'm just trying to show you a visual that great trends come out of bear markets. So just keep that in mind. And is it straight up? Heck no. Both you and I know it's not. But there's money to be made. We don't know how long this prolonged bear market is. You know, for the NASDAQ, as far as that goes, so let's look at this chart for a second. So this hindsight should have been obvious, right? You had the death cross. You had the, you know, lower highs, 1, 2, 3. And then after a big gap up, it just got slammed. So support's getting broke, right? You're in the death cross, support's getting broke. Now it is extremely, extremely oversold, but it's something can stay oversold for a while. I think the resistance area is going to be in the 6850 to 7,000 range because you got this 50-day moving average. It's probably going to meet 7,000, and this could go straight up into this, and I think that's where it's going to hit a wall. I doubt this comes straight up all the way up to the 200-day. We're going to look at some possibilities here in a second, but you know, I think what would be, if it does go straight up into here, I think you have got to, once it goes above the 50-day moving average, if it closes below the 50-day moving average, you need to get out the way. Because it is very, very likely, if this doesn't troll on the bottom for a month or two, and just have time to digest this, if this doesn't troll on the bottom for a month or two, and it goes straight up, the likelihood of it, you know, taking a double dip and testing this low again, a double bottom, I think is better than 50%. I think it's going to happen, actually, probably either way. So you just kind of have to keep that in mind. You always have to look at where's the market going to get me. And I just think a simple rule is if we have a good rally and it goes above the 50-day moving average and then it goes back below the 50-day moving average, just get back out. Just, you know, start selling some stuff and raise a little bit of cash and let it chop around for a bit until we have brighter skies ahead. But I'm looking at this zone as potential resistance. But if it blows past that, use the blue line, right? It's the moving average is just a tool. It's not the end all be all, but it's just such a simple tool to use as a stop. But I mean, don't sit here and tell me that it doesn't work. Support, 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 break support, resistance, resistance. I mean, it works, especially in trending markets. In non-trending markets, it doesn't work. But in a trending market, whether up or down, it does. So just kind of keep that in mind. And it's not an exact science. But you can see right here, look at this candle. It could not close above the blue line. They had to push it down and then boom. And we actually, in the QQQ system, we made very good money on this trade. I was in the leveraged version. I think I sold this one above 20%. Sold half above 20% because it hit our profit target number 1. And we were out the next week, and then it got hit, and we were out, and we averaged out, I think, for an 11%, 12% trade. But man, that's still a pretty good trade. We were in right here, sold half here, sold half here. We were out, and then it just absolutely rolled over. So the NASDAQ and the S&P 500, it looks very, very similar. So I'm not going to cover it too much. It just, it looks like the same chart to me, but man, you got a lot of volume. You just got you've got to get out of the way when these waterfalls start to happen. You just don't know how far down they're going to go. But again, I tend to believe that it's going to break through the 50-day, probably chop its way up to the 20-day, probably chop its way up to the 50-day, and then kind of come back down, chop around a little bit. It's just an opinion. You know what they say about those. So the S&P 500 on the weekly chart, it broke the trend line. It broke the trend line that's going all the way back to 2009. It's been touched so many times. I think it's a legit trend line. Now, does that mean we're going to have a 2008? No, I don't think so. Could we make lower lows? Sure, we could. But if you are taking 1% trades like we just talked about, it shouldn't be that big of a deal on new trades. But we did have a reversal in the market. You can see right here. Maybe I could just blow this up for you a little bit. Kind of blurry, but I can blow this up for you a little bit. You did have a reversal, but there was a lack of volume, but mainly because you were missing a day and a half, right? Christmas Eve was a half day, and then Christmas was a whole day. So you missed a day and a half's worth of volume. But you did have a reversal. I'd probably still say this is a legit reversal just because you were missing a day and a half's worth of volume. It's probably gonna bounce from here. So, we could get a rally and then a double dip, just like this. Look, you got a really good rally coming out. You almost had two double dips. You had a double dip right here, rally, double dip right here, rally. It's out. But my point is, if it rallies above this, actually, let me kind of go. Let me go to these short-term charts. Let me throw the 50-day moving average on here just to kind of prove my point. So you got the red line is the 50-day moving average. So if we get a rally out of this and then it just breaks right here, you're opening yourself to another double dip. So that's what I'm saying. If this happens, and which it could, which it probably will, and then this happens, which I think it probably will, then just get out the way. Let it happen. And we can look at the same in 2011, where, let me add the 50-day moving average right here. You can see this, you can see this stuff happening over and over in history. Kind of have an idea of what to expect. So it rallied above the 50-day moving average. Now, here's a whipsaw. I still would have gotten out here because you don't know if it's going to come all the way down here or not. You had multiple shakeouts, but I think you got to get out if this happens regardless, just because you don't know. You don't know if it's just going to completely get obliterated or not. Let's look at the 2015. In 2010. So right here, resistance at the red line, 50-day moving average, it tried to pop above. Here's a lot of whipsaw, but again, it rallied and then it just came down and broke and then it went lower. So again, I think when it breaks, you just got to move out of the way because you don't know how much lower it's going to go. This wasn't that bad. But then look at the trend. Look at the trend that came out of this thing. So good trends come out of bad markets. So just keep that in mind. Don't worry, I got you covered. So let's look at breadth. Okay, let's look at the 20-day moving average breadth. Only 20% of stocks in the S&P 500 are above the 20-day moving average. Technology, financials, no really good breadth. But we go down here to materials. Materials are perking up. That's your metals, miners, stuff like that. 50%. Look at how utilities were a darling during the November-December sell-off, and then they sold off. Materials are looking strong. We're going to look at strong. I wouldn't call 50% strong, but the strong, yes. If anything has half a rally, I think materials do. We're going to look at that here in a second. But, you know, if you look at the big picture, when you're looking at the market breadth, 20% of stocks are above the 200-day moving average. You just run a simple scan and see, you know, 20% of stocks are above the 20-day moving average of 21. That's about 100 of the 500 stocks. So, you know, run that scan. You can do it on anything and just go look at it. But, you know, only 10% are above the 50-day. 20% are above the 200-day. So that is very, very weak breadth. So we're getting just a weak bounce. So just kind of keep that in mind. If we get a bounce all the way up here and we're still below 40% on the long-term moving average, that should tell you what you need to know as far as if we're going to take a second leg or not. Let's look at, I said we could look at miners, so let's look at miners. You know, I showed you this chart last week. Gold, GLD. It's looking strong. You had GLD that broke out, right? It broke out of this bottoming pattern. It's heading higher. You have gold miners that are really at a pivotal point. They're trying to eat their way through this right here. And if I were to draw, let me draw a, that's not what I meant to do. Let me draw a 200-day moving average on this thing. It eating its way through the 200-day moving average. It's now above it. Really looks suspect. It is at a major, major resistance level. The miners are. So I'll be interested to see how it eats its way through. Don't be surprised if this does break, just because it's just what gold does. It doesn't really like to trend, but you don't want to fall asleep on it either. Just kind of keep your eye on it. I'm noticing some strong miners. Kirkland Gold, that's pretty strong. You know, ABX. So then you have the miners to metals ratio, relative ratio, and when this line is going up, that's when you want to be invested in gold. And miners, the GDX is outperforming the GLD. It broke out of a downtrend, so I'd say that's bullish. It needs to kind of, now it's just kind of performing in line since it broke out. It hasn't really gone, but I'd like to see this line go higher. And then the dollar momentum last week, I showed a slowing, and I believe that trend line is broke. And these have inverse relationships. So when the dollar is strong, should be strong for commodities, at least the metals, since they have an inverse relationship. So, you know, maybe a bull market in gold miners start. I think we're a long ways away. This is still an ugly, ugly downtrend. And you don't really want to be invested in gold unless the gold miners are acting strong as well. So just kind of keep an eye out. This is still an ugly chart. But it's undoing some of the technical damage now above its long-term moving average. Okay, so when the dollar weakens, I showed you this last week. This is the SPX, the S&P, and the VEU, the All World ex-US ETF. So you can see they're very highly correlated until they're not. So there's a big divergence, right? They crossed right here. So, and that's typically when the dollar started to rally. So when the dollar rallies, international stocks underperform, but the opposite is true. When the dollar gets typically weakens, international stocks outperform. So you have, if we look at a chart, the VEU in the last 30 days was down less, right, than the S&P 500. So the S&P 500 sold off more, and it's maybe because this was way overdue. But if I add, let's just say I'm going to add the EEM instead of the VEU. And so you can see that the S&P 500 definitely made lower lows. Well, let me make the S&P 500 invisible for a second. Let me just... Emerging markets did not make a lower low. So the purple is now emerging markets. So the S&P 500 got slaughtered, went straight down. Emerging markets did not. They did the opposite. They had already gotten slaughtered. But now they may, I mean, who knows? This could base for a while, but they did not make a lower low. So I think coming out of this, whenever we do get out of this, I think you're going to see some leadership in the emerging markets and the international stocks again. So that's a positive divergence right there. Underperforming for a long time, and all of a sudden the last couple of months they're not going down as much. They're not undercutting their lows. They've already done that. So just kind of keep that in mind on the emerging markets front. You know, just kind of why I am on that. I did send a chart out. Brazil, EW. Is that iShares? Yeah, let's look at that chart. So there are a few emerging market ETFs that are looking interesting. This EWZS, these small cap Brazil, is looking pretty interesting. You had a new president. Anticipation happened right here. It took off and it created bull flag, and I was trying to break out. Now this is a pretty thin ETF, but I mean this looks like a continuation all day. So I might take a trade here to kind of see what it does, although you kind of got to risk a little bit more than I want. I think the stop is probably 1361. That's not too bad. 1361.14. I'm just trying to calculate in my head. That's about a 7% risk. If you're halfway through the move, that's not bad at all. So that's looking kind of interesting. Another one that is kind of perking up is the Indonesia ETF, because you can see that, you know, it's way off the low and it's basing above the long-term moving average. You're still in a death cross, but it's about to cross over. So it's basing above the long-term moving average, so something also to look at. Indonesia, there is some pockets of strength in Indonesia, India, and Brazil on the emerging markets. I don't know what happened to this guy down here. That kind of makes me nervous, but the India ETF is now above the 50-day moving average and is trying to base. Just a couple more quick charts. Let's look at the VIX. So it just spiked way above 30, and you can see the last two times it spiked above 30. Both times it took another stab. This time I believe was at the low. You had a double test of the low. And this time it did continue to go lower. So just because you get that spike, yes, that can be a buying opportunity for a bounce, but it doesn't always mean that it is the low. So the last two times this happened, it took another dip to test that low. Now this really isn't that much lower at all. This I think is the same price right here. So I would expect the same thing. I would expect a bounce and then a double test. So just kind of keep that in mind. So last chart. Bonds, TLT, 20-year Treasury, broke out clear as day. And it's interesting because utilities are typically correlated with the TLT, and they've been negatively correlated, so they've been getting slaughtered. But you have a 2-year downtrend. And that's legit. When you have a 2-year downtrend, a trend line that gets touched 3 times, you got a false breakout right here, then a definitive breakout right here. Bonds are back, baby, so they're looking all right. I don't know if that's a good thing or a bad thing, but bonds and stocks, they can move together, so I don't freak out when bond prices go up, because historically they can move with stocks. Typically, what happens is bonds will correct before stocks, and they will bottom before stocks. So that correlation would make sense. If the bonds are bottoming before stocks, it could mean stocks are not ready. And typically they can bottom months in advance and then come out of this. So bonds move before stocks on the upside and the downside. So I hope everything was helpful. I hope you really put some thought into the risk and position sizing ideas that I gave you, and I hope that my story and what I'm trying to work on in 2019 really inspires you to make some changes as well, because unless you're batting 1,000, I know we all could do better, And for my paying subscribers, I hope that you guys, even though November and December were not a fun sell-off, but I hope you guys should have definitely made some money this year. And for my trading system subscribers, I know you guys are happy. So if you want to subscribe to these two plans, again, go to thetradersplan.com/subscribe, and you can go with the annual or monthly plan. And if you want the trading system, you want this kind of performance, you can go to checkout-TS, use the coupon code 6FREE, and that'll get you an additional 6 free months. So I hope everyone has a fabulous 2019, and we'll talk soon.